Good morning and welcome to another live technical analysis session. Starting off with the euro instead of the Swissy, and it looks like we have a few problems with our MT4 platform. So just bear with me until I try and fix this particular issue. And let's see if we can fix this now. Screen share. Uh, there we go. And let's see what we can do now. Uh, just a moment, please. We are trying to fix our particular issues that we are having today. Let's see. So this is me, and this should be the chart. Let's see if it is fixed. No, there are issues with the MT4 platform. Never mind. They are now fixed. Sorry for that. So we are starting off with the euro against the US dollar. As you can see, it is moving in a predominantly sideways fashion. It is above that S1 support level of 1.0470, but remains below the resistance level at 1.060. It is a key psychological figure and a big figure as well. Despite this wick piercing through our R1 level, it still remains the same, as it has not been violated, i.e., it has not closed above, and thus this may have been simply seeking liquidity for the pair to continue moving in a sideways direction. If you look at the RSI, it is currently at 42, which does imply some bearish market tendencies. Later on in the week, we're going to have the ECB's interest rate decision, in which they are expected to cut interest rates, which in turn could weigh on the euro. However, tomorrow we do have the US CPI rates, and as such, those could dictate the particular pair's direction. For example, if the CPI rates come in hotter than expected, implying persistent inflationary pressures, then we could see the euro moving lower against the US dollar. In particular, we would like to see a clear break below that S1 level at 1.0470. Lower than that, we have 1.0330, and then even lower than that, 1.0220. So for a bearish outlook, would require a clear break below that S1 level, followed by the next potential target at S2, and then perhaps even S3. Now, let's place a hypothetical. Let's say the CPI rates for the US come in hotter than expected, and we see the euro moving lower against the US dollar. Then we have the ECB's interest rate decision. If they don't cut rates and are hawkish, then we could see a potential reversal. So, for example, let's say if tomorrow the CPI is coming hotter than expected, we could see the euro moving towards that S2 support level. And then if the ECB is hawkish, we could see a retracement back up to that S1, maybe even R1. Now, it does depend on what we're going to see with the CPI rates, followed by the ECB's interest rate decision. If you ask me, the unemployment rate doesn't really warrant the Fed to cut interest rates, so that could be aiding the US dollar in general. Now, it all depends on the ECB. The situation in the zone is not that well. The manufacturing PMI figures are still in contraction territory. They may have came in better than expected, but are still worrying. Then you also add in the geopolitical risks, so the political level, France and Germany and France heading for early elections. In particular, for France, we need a new prime minister following the resignation of Macron's pick. So that is a bit of an issue. But overall, I would not be surprised to see the ECB cutting. But of course, that is a hypothetical, and we must see what the ECB actually does. For now, from a technical point of view, you could say that this might be a higher high. We could be seeing a retracement back down to S1 and then maintaining a sideways bias. If it breaks above R1, we would opt for a bullish outlook up to R2. As you can see, it is in the middle of this order block and is touching on a prior support level, and thus we might see heavy selling pressure at 1.0760. USD JPY bounced off S1, has broken above the downwards moving trend line, RSI is near 50. If it closes today above that R1 level, 151.30, then we could opt for that bullish outlook. Note on the 4-hour time frame, how the pairs price action respected that R1 level. So it was met with resistance and then broke above. So I would expect a potential retracement to that R1 turn to support level before continuing on its ascent if you are using that 4 hour time frame. So here I would expect some support. Overall, we could opt for a bullish outlook as long as it closes the day above this R1 level. GBP USD moving in an upwards fashion, taking aim for that R1 resistance level at 1.2845. But if you look at the RSI, it is on 50, implying a neutral market sentiment. But we are maintaining a bullish outlook given that we do have an upwards moving trend line that does remain intact. So as long as this upwards moving trend line is intact and it breaks above R1, we could opt and maintain that bullish outlook. If it fails to break above R1 and then pierces through the upwards moving trend line, then we could opt for a sideways pass between S1 and R1. As we said for the euro, and the same goes for the JPY, it does depend on the release of the US CPI rates tomorrow. So this could also be impacted as well. USD CAD taking aim for that R1 level at 101.420 round figure, broken above the above the sideways moving channel. Upwards moving trend line remains intact as well, opting for a bullish outlook, which is also aided by the RSI indicator below our chart, which currently registers a figure close to 70. For the Aussie is interesting. So, two things that we should note. One was the RBA's interest rate decision earlier on today. It appears to be predominantly dovish in nature, so implying rate cuts down the line, which in turn could weigh on the Aussie. Moreover, we have China's trade data. So, Australia and China have a very close economic relationship. Raw materials from Australia are imported by China. So the trade data also impacts the Aussie. The lower than expected and significantly lower imports rate is concerning for Australian traders, as a lower than expected imports rate may imply lower demand for goods from Australia, which in turn could further weigh on the Australian dollar. I would opt for a bearish outlook for the particular pair. We have the downwards moving trend line. We have the fundamentals aiding our analysis as well, which is bearish in nature. And the RSI currently registers a figure of 37, further implying a bearish market sentiment. For my bearish outlook to continue, however, I would require a clear break below that S1 level of 0.6360. So if it breaks below that S1 level, then we could maintain our bearish outlook down to 0.6270, which is a potential support level. The S&B's interest rate decision is set to occur as well in 2 days' time. They're expected to cut, which in itself could weigh on the Swiss franc. Now, in turn, that could allow the dollar to gain. But as you can see currently, the RSI is resting on the figure of 50. It has relatively bounced off that S1 level of 0.8750, but there is still a downward moving trend line. So what we might be seeing currently is a retracement before moving lower. If the S&B cuts interest rates and is predominantly dovish in its accompanying statement, then we could see the Swiss franc moving lower. So USD CHF could move in an upwards fashion, potentially taking in for that R1 resistance level of 0.8920. But if we see a strengthening of the Swiss franc, so a more hawkish central bank, then we could see the Swiss franc gaining, potentially breaking below S1 at 0.8750. And then lower than that, we have 0.8555. Now, I can tell that it is significantly lower and it is a big distance away from that S1 level. So we could readjust that support level and bring it closer to that S1. In particular, we're looking towards this swing low. So it broke above this resistance level, 1, 2, 3, touches a fourth touch as well, rested on it. So it was resistance turned to support, tested it, so validated that this is indeed support and moved higher. So I would be readjusting that S1 level to 0.8610. So that would be my S1, my S2. And then for that S3, we also need to readjust and bring this higher. And this was a sideways moving channel, so it's a bit far away. But maybe we can take this high here, support, found, acted as support and moved higher. So placing S3 at 0.8555 6.455. So this would be my S3 level. Now it is, if I remove this box here, you can tell yourself that this is a bit difficult in terms of there are many points upon one might actually find support, but either it would be too close to that S2 level or it would be too far away. So this is relatively a midpoint upon which we saw the most recent support other than S2 that still gives the pair some, let's say, some leeway should the pairs try to find some liquidity. And same goes for the bulls. And I will explain exactly what I mean in just a moment. So this is my S3 level. What I mean by liquidity for the bears and the bulls as well is if it breaks below that S2 level, one could argue, well, look, this is actually a potential support level. They would be right as well. But if it breaks below that S2, so breaks below and S1, it means that the primary direction is moving in a downwards fashion. And in this area, which we had indicated by that rectangular box before, you're seeing heavy buying pressure upon which it moved higher. So it could pierce through. So you could see a wick, whereas the candle could remain close to this level here, but we might actually meet significant support at 0.8455. It is very volatile. And if it does reach that S3 level, we will most likely need to readjust our support level as well. The Kiwi I'm going to ignore. Oil is moving in a predominantly sideways fashion. Now, this is interesting considering the developments in Syria with the fall of the Assad regime. One may have expected oil to move higher, but with the Syrian backed Kurdish forces taking control of Syria's oil fields in the north, so even more control, we might be seeing a relative stability. We could also note that this might be a downwards moving trend line. This was one, and then we might be seeing a second being formed currently, which may imply a bearish market sentiment. The RSI is at 50, and this is moving in a sideways channel as well. So we would opt for a sideways bias, but we would immediately switch our sideways bias in favor of a bearish outlook if it breaks below this S1 support level at 66.45. So key support breaks below. Next target could be 61.45. If it breaks above, the next target could be 77.85. So we do have resistance at 72.10, support at 66.45. Gold, we are on a daily chart. 2685 is my R1 resistance line. I've got support at 2.6k, nice round figure. RSI is still at 15, so I wouldn't be bullish nor bearish on the precious metals price. Um, the geopolitical tensions haven't aided gold's price that much. We're seeing some stability in Syria, although I do think that could easily fall apart within the next couple of minutes, next couple of hours, or even days. It's still very volatile, so we might be seeing some upwards pressures on gold's price. Overall, though, with the technicals, there size at 50. If it meets resistance at 2,685 and fails to break above, it could stay in a sideways bias, a sideways fashion. Breaks above R1, same story. Target could be R2, 2,790. For gold, there are some tensions rising in Asia. In particular, China is encircling Taiwan, potentially for military drills, but that is not something we haven't seen before. So, nothing major on gold's front. Looking at Intel. So, Intel is back down below that old resistance, turned to support, now turned back to resistance level below 2210. It does appear to be moving in a downwards fashion. So China is now retaliating, I would say, against America in preparation of a trade war. That is why, excuse me, you will also see Nvidia probably moving lower. China has launched an anti-monopoly investigation into Nvidia. Allegedly, they're violating their monopoly competition rules. Could be weighing on Nvidia, could be weighing on Intel. We're seeing tit for tat from the US and China. So essentially in preparation for that trade war that might occur with the Trump administration beginning January. So let's look at Nvidia, also moving lower, capped lower. So this is probably the announcement of the investigation by China. Could be weighing on the company's stock price. Also bad for the S&P 500. Microsoft, however, is moving higher, has broken above R1, R2, currently taking aim for that old R3 level at 453.14, opting for a bullish outlook. OBV, so on balance volume, supports the current direction, so the current trend. RSI is at 68, bullish as well. Overall bullish for Microsoft. So good news if you're holding Microsoft. ExxonMobil surprisingly is moving lower, has broken below that 113.13 support level. Could be due to lower oil prices, might be a bit of a concern, but slightly bearish for the company's stock price. What else should we look at? The FTSE, as always, moving in a sideways bias, hasn't broken above R1 and has not broken below S1. Tesla, bound to see a retracement at some point. Uh, Gap up. This could be an exhaustion gap, but was not an exhaustion gap. Moving higher and higher and higher. $389 per share, roughly. Bullish for Tesla, close proximity to the president. Could be beneficial as well. McDonald's about to break above that 299.55 support and resistance, now support level. IBM, retracement, copper, old ticker. LVMH making some grounds, but the issue in China is pretty bad, so I wouldn't be surprised to see that stock price remaining between S1 and R1, as you can see on your screens. Volkswagen, Google, Deutsche Bank resting above that 16.70 old resistance turn to support. JP Morgan about to move lower, bearish for JP Morgan. Dow Jones 30 retracing. The Nasdaq, bit of a retracement, but predominantly bullish in nature. S&P 500 testing that support at 6,050. So this is resistance turn to support. So this becomes support. This becomes S2. We keep saying the same things, but we have no choice. This is what moves the market. If I was looking at this, which I am, I would place emphasis on the ECB, the BOC's interest rate decision later on this week, and the CPI rates. Tomorrow we've got CPI and the BOC. If I'm not mistaken, the Bank of Canada is expected to cut interest rates as well. So if we go back to USD CAD, you might see the Canadian dollar moving lower. As you can see from yesterday, this could simply be a retracement. If the Bank of Canada cuts interest rates, that's dovish, could weigh on the loonie, could allow the dollar to gain. In combination with a better than expected CPI print, could boost USD CAD potentially up to that R2 resistance level. So I would be focusing on the ECB, BOC, and the US CPI rates. Those are the three main events of the week. So that's what I would be emphasizing and looking closely to see the reaction, see what comes out. And then, depending on that, we could either maintain our bullish outlook, switch it towards a sideways bias, or even a bearish outlook, depending on the releases. It purely depends on what comes out from the Bank of Canada, the decision, and then the accompanying statement. I wouldn't be surprised to see the BOC cutting interest rates. Same goes with the ECB. So the ECB would be very interesting. The ECB, we are seeing some issues and weakening in the zone. So I would not be surprised to see the bank adopting a more dovish tone, potentially to aid the common currency and, in general, the Eurozone's economies. For the Bank of Canada, same situation. Would not be surprised to see the bank cutting interest rates. So I would not be surprised to see the euro and the Canadian dollar weakening against the US dollar. Now, that of course depends on the US CPI rates. If the US CPI is coming in lower than expected, implying easing inflation pressures, then we could actually see these currencies gaining. And then potentially with the interest rate decisions, a potential retracement. Something came from the screen. Nonetheless, that's predominantly it. So we've done the S&P, we've done the major pairs. We'll have a look tomorrow. So tomorrow we can prepare for the ECB's and BOC's interest rate decisions. Same with the CPI rates. We'll have a more in-depth discussion, analysis, and we can see what changes from today to tomorrow. We might readjust our support and resistance levels. If you have questions, feel free to ask or come ready for tomorrow's live session. It's going to be the same time, same place. Euro Stocks 50 actually moving very nicely higher. This could be a swing high, so we might be seeing a retracement. Not bad, not bad for the Euro stocks. Deutsche Bank moving higher. Boeing, not even going to discuss Boeing. Could be retracement before moving higher. So this is going to be very interesting. We do have an interesting week ahead. But of course, those are the events that we are going to be looking towards. This is predominantly it for the technical analysis. If there is an indicator, if there is something in particular you would like to ask, please come prepared tomorrow. Ask, and I will be answering questions. Geopolitics, I would be looking at Syria, although it doesn't look to have that big of an impact on the markets. Emphasis on the ECB, comments potentially by BOJ policymakers. As a reminder, we are in the Fed's blackout period, so we aren't expecting comments from Fed policymakers. And thus, it will be very interesting to see what they do decide in their next meeting, which, if I'm not mistaken, is on the 17th of this month. And of course, we will be monitoring that as well. So for today, nothing that major. I think everyone is preparing for the CPI rates and the BOC's decision tomorrow. And then we do have the SMB and the ECB on Thursday. And with that, that does it for today. Thank you for tuning in. If you do have any questions, I will be here tomorrow, same time, same place. Come ready, ask ahead. We can have a look at some pairs that we haven't looked at together. Perhaps we can do something more in depth. We can look at a 4 hour, perhaps even a 15-minute time frame. We can chart together and see the pairs or indexes or even a commodities direction. With that, thanks for tuning in. I will see all of you tomorrow.
Okay, let's go ahead and get started. So as usual, a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk. it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. I'm Melanie, and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We are going to be talking about what exactly hedging is, the different types of hedging, what correlation is, and lastly, some risk management techniques. If we have time at the end, we might go through some charts. But that's if we get through our slides. Okay, so let's go ahead and get started. So what exactly is hedging? So in Forex trading, hedging is a key risk management strategy that helps to offset potential losses by taking a counteracting position in the same or a correlated asset. So you can think of it like buying insurance for a trade. You're basically protecting yourself from adverse market movements that could harm your primary position. So how does it work? When you enter a trade, you're essentially balancing the risk of your initial position by opening an opposing trade. So this counter position can reduce or even neutralize your losses if the market moves against your main trade. So the example I have here is, suppose you are holding a long position on the euro dollar because you expect euro to strengthen against the US dollar. However, there's an upcoming economic event, perhaps a Federal Reserve announcement, that could create volatility. So to hedge, you open a short position in euro dollar to balance out your initial position. So if the euro weakens and the euro dollar drops, the loss in your long position will be offset by the gain in your short position. So in essence, your potential loss is minimized because gains from one position offset losses in the other. So this kind of balance helps protect your capital and keeps your portfolio steady through unpredictable movements. So why hedge? So many of us are aware of the extreme volatility involved in forex markets. So prices can be affected by global events, political developments, and economic announcements. And sometimes this can lead to significant fluctuations within minutes. So firstly, we have risk mitigation. So at its core, hedging allows traders to limit their exposure to these unpredictable market swings. So by offsetting risk, you as a trader can reduce the impact of an adverse price move on their primary position. Secondly, we have capital preservation. So preserving your trading capital is critical, especially for long-term trading success. So by using these hedging strategies, you can protect against catastrophic losses that could erase weeks or even months of gains. So for example, if you're heavily exposed to the US dollar in multiple trades, you might hedge by taking a position that benefits from the US dollar depreciation. Number three, profit consistency. So hedging can help to stabilize your returns over time. Rather than risking a high impact loss, you gain more consistent returns by smoothing out your profit and loss curve. Number four, market neutrality. Hedging also provides a way to maintain a more neutral position during uncertain times. So for instance, if you have a strong dollar bias, but sense a period of volatility, a hedge allows you to protect your portfolio while still capitalizing on profitable opportunities. So in summary, hedging isn't just about avoiding losses, it's about achieving more stable, more predictable trading outcomes. So yeah, you may sacrifice some profit potential, but the reduced risk exposure can be worthwhile. Okay, so let's talk about the different types of forex hedging strategies. Firstly is direct hedging. So this is the simplest and most commonly used method. Excuse me. And what exactly it is basically opening and offsetting position in that same currency pair. So the example I have here is if you're long on euro dollar, you would open a short in euro dollar as a hedge. Cross hedging, this approach uses correlated currencies to create a hedge. So if you're long on pound dollar, you might go short on euro dollar or dollar yen because they're historically correlated. Options-based hedging. Forex options provide a more flexible way to hedge. Options give you the right to buy or sell at a predetermined price without the obligation to do so. So this flexibility helps you to manage risk while keeping costs low. And lastly, forward and futures hedging. This involves locking in a currency price for a specific date in the future, either through a forward or futures contract, and it's commonly used by corporations to hedge against currency risk in international trade, but can also benefit individual traders. So each of these methods basically offer unique benefits and cons as well, depending on your trading style, your risk tolerance, and market outlook. So in the next slides, we'll go through each of these strategies in more detail. And we're going to start off with direct hedging because it's the most straightforward method. So it involves holding both a long and short position in the same currency pair. So for example, if you're long on dollar yen, you would open short on dollar yen position, and this directly offsets the movement of your original position, reducing your overall risk. Pros is that this approach is simple and effective, especially in highly volatile market conditions. So you don't have to worry about correlations with other pairs as you're hedging within the same currency pair. Cons is that direct hedging can limit your profit potential, since gains on one side offset losses on the other. Additionally, because you're holding two positions, transaction costs like spreads and swaps can add up pretty quickly, making it important to monitor your trades closely. So let's say you're long on dollar yen, expecting the dollar to appreciate against the yen. However, due to upcoming geopolitical events, you're unsure if this appreciation will occur. So to protect yourself, you open a short position in the same currency pair, dollar yen. And if the dollar weakens, the short position compensates for the loss on your long position. So direct hedging is basically, it's quite often used by beginners since it's quite simple, but you want to always remember to account for the additional costs involved when you are holding two opposing positions. Okay, next, let's look at cross-hedging. So cross-hedging takes a different approach by using correlated currency pairs to hedge a position. So in cross-hedging, you identify a currency pair that moves in a similar way to your original position, but isn't the same. So for example, if you're long on pound dollar, you might short the euro dollar because the two pairs are often correlated with the US dollar. So an example here is suppose you hold a long position on the dollar yen, betting on US dollar appreciation against the yen. To hedge, you open a short position on euro dollar, and since both pairs have USD as the base currency, a movement in the dollar will affect both positions. Advantages is that it's more cost effective because spreads on certain pairs may be narrower than a direct hedge. It also provides some flexibility since you're not fully canceling out your exposure to the main currency. Um, Risk-wise, the primary risk here is correlation risk. While pairs may generally be correlated, they don't always move in perfect tandem. So in some cases, the pairs may diverge, leading to unanticipated losses on both positions. So overall, cross-hedging is ideal for experienced traders who have a pretty good understanding of currency correlations and want to hedge cost effectively. Okay, now let's talk a bit about correlation and what exactly it is. So what exactly is correlation? It basically refers to the statistical relationship between two financial instruments or assets, such as stocks, currencies, commodities, etc. So positive correlation means that the two assets are moving in the same direction, and a negative correlation means that they're moving in opposite directions. So for example, if the price of gold and the value of the US dollar have a negative correlation, which they do, then when the price of gold goes up, the value of the US dollar typically will go down and vice versa. So a perfect positive correlation is +1, while a negative perfect correlation is -1. So we typically look for strong correlations with values of 0.8 and above 0.8 and above, or below -0.8. Okay, so we already talked about how correlation helps you to manage risk, and it's a form of hedging as well. So traders use correlation to identify potential trade opportunities and manage risk. For example, if a trader holds a long position in a stock, they may want to consider taking a short position in a negatively correlated asset to offset some of the risk of the long position. It's important to note that correlations can change over time, so traders must continually monitor their relationships. Additionally, correlation does not equal causation, meaning that just because two assets have a high correlation, it doesn't mean that one is causing the other to move. Okay, so we have a couple of examples of how you can find the most or least correlated forex currencies in real time. The example we have here is my FX book. So you can make use of this filter, correlation filter here, to find what you are looking for and adjust the time frame to whatever you prefer. So we typically want to look for correlations that are higher than 80 and lower than -80. So you simply input that into the filter and it will highlight all the currency pairs that match up with what you have requested. So that's a really easy way of finding correlations. We also have another table from CMC, and this shows you how the different currencies relate to one another as well. Okay, any questions so far? Okay. So let's now look at some examples. So some positively correlated currencies are the AUD and Kiwi dollar. We also have the euro and the pound, dollar index, CAD, and franc. So for this example, I'm using Aus franc and Aus CAD because it's giving us a 84.2% positive correlation, which is quite positively correlated. Okay, because remember we said we only consider it to be positively correlated if it's above 80 or below. Yeah. Positively correlated if it's above 80, negatively if it's -80. Okay. So here, this is a chart of the Aus franc price chart. This is on our daily time frame. And this is what our Australian Canadian dollar looks like. Okay, so if we compare the two, you can see our AusCAD on the daily time frame is quite similar in if we're just talking about the shape of price. Okay, we have a question. Can we not hedge with options? Yeah, you can. I think we did mention that as one of the types of hedging strategies as well, option-based hedging earlier, just in the earlier slides. But for now, I'm just talking a bit about correlation with regards to Forex currencies. We'll get into options in a bit. Yeah, so back to what I was saying, yeah, this is a tool on TradingView that just allows you to compare the two different price charts on the same price scale so that you can see exactly how positively or negatively correlated they are. Another example we have is the pound dollar and pound yen, and you can see that the shape of the price charts are very similar. Yeah, so both are also very positively correlated. Another example here we have Kiwi yen and Oz yen. As I mentioned earlier, Oz and Kiwi are historically pretty closely related as well. Yeah. So again, this is on TradingView. Just by the from the price charts, candlestick charts, you can already see the similarities in the shape. But when you compare it on the same price scale, it's a lot easier to see that similarities. Okay, we also have the SPX and the euro dollar that are positively correlated as well. Now let's move on to negatively correlated currencies, which tend to be DXY and gold and DXY and Oz. So with DXY and gold, DXY and euro as well. Okay, for DXY and gold, they are negatively correlated quite often or normally, simply because they're both safe haven assets. So if the dollar index drops, we'll typically expect the price of gold to go up. And that's heavily dependent on your fundamental analysis as well. So that's why it's important for us to keep up to date with any economic releases or data releases, especially any FOMC meetings, unemployment data with regards to the US economy that tends to have a direct and quite high impact on our DXY and as a result, gold as well. Okay, but as I mentioned, they are not always negatively correlated, so you do have to check on your prices or check on your charts regularly. Because things like geopolitical events, things like that can also affect the correlation as well. Okay, so for this example, we're going to be looking at Euro Oz and Oz franc, which are in this case very negatively correlated and minus 90.9%. Okay, so looking at a couple of examples, Oz franc. So you can see prices moving above the Ichimoku cloud. So that's a pretty bullish signal. Whereas on our Euro Oz, prices are moving below, giving us a pretty bearish signal. So if we compare it on the same price scale, you can see prices are pretty negatively correlated. Okay, and another example here, we have Oz dollar and dollar CAD, very negatively correlated as well. SPX and gold, and DXY and gold as well. Okay, I think you guys kind of get it by now. But in this example, we're kind of using correlation to identify breakouts. So the breakouts we're talking about here are breakouts out of this resistance level or support level in the case of the XY here. So here we have a resistance level with two swing highs. And we can see prices breaking out of the that resistance level for gold. As for dollar or DXY, we have that same um resistance or support level, okay, with the two swing lows. So we're expecting price to break out of it again just further down the line. So you can see here at 10:02, prices broke out of that resistance level. Now on our DXY, prices broke below it after that timing, 1 o'clock. Okay. Okay. Now let's talk about options-based hedging. So options-based hedging is a more sophisticated approach that offers flexibility, allowing you to manage risk without committing to a specific position. So a forex option provides the right, but not the obligation to buy or sell a currency pair at a specific price by a particular date. So you can choose to let the option expire if it's not advantageous. Benefits, there's flexibility. You can let the option expire if the market moves favorably, making this a versatile strategy. Cost effectiveness as well. Options generally have lower upfront costs compared to maintaining two active positions in direct hedging. So an example of this, imagine you are going long on the euro dollar and you're expecting a rise. So, however, you are concerned about a potential drop. So you buy a put option on euro dollar. So if the euro dollar indeed falls, the options gain value, offsetting losses on your primary position. So options can be overall quite powerful tools for traders, but selecting the right strike price and expiration requires understanding premiums and the options time decay. So they're well suited for traders who are looking for hedging flexibility without needing constant monitoring. Okay, so let's talk a bit about risk management strategies when it comes to hedging. So in order to figure out what exactly or how exactly we can manage risk and manage a trade, we need to understand what exactly a trade will consist of. Okay, firstly, of course, we have the entry, the stop loss orders, take profit orders. And then we also have your break even, partial profit, idea and validation, trading stop, and diversification. So I guess I'll just go through this side of things. Break even is pretty self-explanatory, I think. It's basically, and we'll go through it more in depth on how we do things. Partial profit, it's in the name, is quite explanatory as well. And we'll give you some examples. Idea and validation, basically happens when you are going in for a trade and you are admitting that um there's a certain position where price exceeds that and you're trying to get out of that trade basically. Yeah, that's your idea and validation point, and that's where you get out of the trade. Trading stop loss, this strategy basically involves adjusting the stop loss levels as the price moves in the trader's favor. So it basically allows for profits to be protected while giving the trade room to continue moving in the desired direction. Okay, and lastly, diversification. Of course, spreading out investments across different assets, markets, and sectors helps to reduce your overall risk. Hedging also helps to do this as well. Okay, so firstly, where you place your stop loss and your take profit are really important. So here we're talking about trade management with confluence, and confluence here we're talking about is Fibonacci confluence. So starting off with our stop loss, you want to make sure that your stop loss is always placed beyond a key Fibonacci area. So key Fibonacci area basically is when two or more Fibonacci levels line up in that same area. That's a confluence area. Okay, these areas are important because more often than not, prices tends to be attracted to these areas, but it might not be able to break out of it. Okay, so firstly, stop loss should be placed beyond because if your stop loss is placed right before, excuse me, you will most likely get stopped out before the market reverses. And that's also one of the reasons why most people wonder why they got stopped out right before the market starts to reverse. And then they start complaining about stop hunting. Okay, as for take profit, excuse me. So as for take profit, we should always place it before a key Fibonacci confluence area. Reason for this is because when price reaches your Fibonacci confluence area, there's a high chance that it won't be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry or even worse, your stop loss. So that's also one of the reasons why people complain that the market is being manipulated because they miss their take profit by 1 pip. So if you look at the image I've included here, this is for the example of a buy entry. So in the case of a buy entry, your take profit would obviously be above your entry level. And in this case, we will be placing it below or before your confluence area. Stop loss will be placed below or beyond your confluence area. Okay, so here we're saying to always put it beyond so that there's some buffer in case the market doesn't go up right away when you buy. Okay, this case, this example, we are using a major resistance area. Your stop loss will be placed beyond it and your take profit placed before. So this is an example when we're going in for a sell entry, which explains why our take profit is below. Okay? Okay, some other examples. Of risk management techniques. Earlier, we mentioned the trading stop loss. So what exactly it is it's a type of dynamic stop loss order that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trading stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So the example here is, let's say you buy a stock at $100 and you set a trading stop loss at $10. So as the stock price rises to 110, the stop loss will follow. Now at $100, 110 minus $10. So if the stock price drops to 110, your stop loss will trigger, selling your position and protecting your profits. So this allows traders to manage risk and lock in profits dynamically as the market moves. And this is different from a fixed stop loss, which we talked about before, which is set at a specific price and doesn't change as the market moves. Okay, so it's important to note that the trading stop loss is not a guarantee that you will exit a trade at the desired price. Market conditions such as gaps or rapid price movements can trigger a stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trailing stop loss in combination with a solid risk management strategy. Okay, let's talk a bit about the different methods of using a trailing stop loss. Excuse me. So here's a summary of all the different types of trailing stop loss methods that we'll be going through today. Sorry. So first is the moving average indicator, which I think would probably be the most common, followed by our parabolic star, chandelier, ATR indicator, um, support and resistance levels, and just a combination of all of these methods. Okay. Okay, starting off with our moving averages. So you can see in this example, prices are moving in this ascending trend line. They're also moving above this blue line, which is our moving average. And we're going in for sell entry because we're expecting prices, or you can kind of see prices breaking out of the ascending trend line and also breaking below this support level. Okay, so it broke out, and our trading stop loss is triggered once price crosses over our moving average indicator. Okay, which basically suggests a change in trend. See, so it got us out before this happened. So next, we're looking at a trend line breakout. Here we have prices also moving in a descending trend line, and we're using the same price chart as before. The trend line trading stop loss is triggered when price crosses over or breaks out of that trend line. Parabolic SAR is the same kind of concept. Once price moves over, crosses over that indicator, the trading stop loss is triggered and you get out the trade. Chandelier and ATR as well. Yeah, here's an example. So here we are using a combination of moving average and our support and resistance levels, as well as an ascending trend line. So with ascending trend line here, with prices breaking out, we're going in for a sell entry and your take profit. We got out at our take profit. Okay, so breakouts are usually high volatility events, like when it breaks out of your trend line, trend channel, and those kind of are your trailing stop loss as well. Price can spike up and reverse almost as quickly. And a stop loss can help you to manage risk, protect your capital. Trailing stop loss can help you to protect your profit as well. So again, here we are using parabolic SAR, moving average. We're just basically trying to make use of the different indicators to kind of confirm our analysis. So you'll go in with your support and resistance levels like we have done here, basically marking out all of the swing highs or swing lows that we can identify, and then go in with our indicators to show, I guess, to try and identify if there's any change in trend or if the trend is going to continue. Okay. Okay, so let's now dive into break evens. Are there any questions on trailing stop loss before we move on to break even? No, all good. Okay, great. So the next risk management technique we're going to talk about is break even. Um, so for break even, it's basically a level, excuse me, where you are in profit and you recognize that there is a risk of reversal back to your entry. So it's basically you saying if I'm right, price should go all the way to my target, but if I'm wrong, you should get out. Okay. Okay, we have a question. Can we use Heigen Ashi candles to define SL? Yeah, you can. Um, and you can also use that for trading stop loss as well, based on your candle color. So one simple approach to adjust your stop loss when the color changes is basically when it signals a potential trend reversal. So if in a long trade you set your stop loss just below the most recent HA low, um, then in a short trade, you will place the stop loss above the most recent HA high. So when the color of your candle shifts from green to red in an uptrend, it can be a signal to tighten your stop loss or consider exiting the trade. So that's how you can use the HA highs and lows as well. Um, you can also combine HA with moving averages as well. So yeah, so it's just extra confirmation as well. Okay. Yeah, but thanks for the question. Um, yeah, so back to break even. So a break-even point is where the value of an asset or trade exactly covers all associated costs, meaning that there's neither profit or loss, right? So for forex traders, it's the price level where gains from a position offset its costs, including any entry fees, spreads, or any other transaction costs. Okay, when we're talking about hedging, just moving away from this slide a little bit, it becomes a bit more complex because you often have opposing positions, like we talked about before, with direct hedging or even options-based hedging. Since you are for direct hedging, you are going for both long and short positions. The break even would occur when the total combined gains of both trades equals the transaction costs. So that would include your spreads, your swaps, etc. For options-based hedging, the break even is reached when the underlying currency pair moves enough to cover the option premium. So if you bought a put option, for example, the break even would be the strike price minus the premium paid. Okay? Um, yeah. So just to clarify, since we are talking about break even and we are also talking about hedging, break even is quite an important concept since it kind of determines the minimum performance that you need to cover your costs and also avoid a loss. Okay, now back to this slide. This is just a risk management strategy as well, of or like a suggestion of where you can place your stop loss or your take profit. Um, oh, in this case, we are looking at a modified stop loss. So for your entry, you are placing it at this swing to the swing high resistance, right? Price broke out of it, so we're going in for a buy entry, hoping for price to push to our take profit, this green level here. Our original stop loss is way below here, below this swing low. But once price has broken above this break-even level, we would then move our stop loss all the way up here to our entry. Okay, so that it protects our position. So if price continues to rise, that's great, but if it reverses, we want to make sure that we're protected over here. Okay, so it's a good thing that we did because price then reversed and we got out of this losing trade at break even. Okay, next let's look at our last risk management strategy, which is idea and validation. So I mentioned earlier, it's basically placed before your stop loss. It's a level where you admit that you're wrong and you want to get out ASAP. So when this level is reached, your take profit is moved to your entry instead, giving you a small chance to get out at break even. So earlier we were moving our stop loss. Oops. Oops. Why is it not going back? Yeah. So earlier for break even, we're moving our stop loss to our entry. Here we are moving our take profit to our entry instead. Okay. So your sell entry, we're hoping for price to drop all the way down to our take profit over here. And you can take note of where we place our take profit as well. We place it before this support level, since there are 3 swing lows in the support. As for our stop loss, we're placing it beyond this huge resistance area here with the swing high. Okay, so price reversed and it triggered our idea and validation level. So then we'll move our take profit up to the entry level instead. Okay, so this got us out of a losing trade before price rose further and would have us stopped out. Okay. Are there any questions? Okay, so I guess that's it for today. Just to kind of summarize, um, or like some final tips for effective hedging. Firstly, is to understand correlations if you are interested in that kind of hedging. Next is to watch the costs because hedging costs can eat into your profits as well. So you want to make sure that you keep an eye on your spreads, your premiums, and other fees, and also avoid over hedging. So if you hedge too many positions, it can complicate your portfolio and reduce your returns. Okay, thank you guys for sticking with me through the session. I will stay around. If you guys have any questions, just let me know in the chat. If not, yeah, I hope you guys found this session helpful. We covered quite a bit today, from basics of hedging to some risk management strategies. So yeah, um, yeah, have a great rest of your week, and I will see you guys again next week. Thanks, everyone. Bye. And if you guys liked me, feel free to connect with me on LinkedIn. It's just my name, Manli Chong. Yeah. Otherwise, I'll see you guys again next week. Thanks, everybody. Bye. Thanks, everyone. See you guys next week.